Thank you very much for inviting me to participate in your brown bag seminar series. It's a pleasure to be here. Jeff told me that this is a relatively informal group. It seems to be quite formal going sitting around this table. Therefore, I prepared some informal comments about banking in the U.S. and some other countries. And Jeff suggested that my purpose ought to be to try to stimulate you to think about banking, the way in which we ought to regulate banks in the context of an overall financial system. That's my assigned task, is to just talk about banking in general terms, and then perhaps some of you to ask some questions, make some comments, so that perhaps I can learn more about banking, how it has been regulated in different countries, and how perhaps one might use the word ought to be regulated, if at all, in different countries, including the United States. There's a lot of interest in banking. That's an area in which I tend to do some research. I have a great interest, in fact, in the way in which banks have been regulated in the United States, and now I'm somewhat more interested in how banks have been regulated and are being regulated in countries beyond the United States. And in particular, I've looked at some of the bank regulatory systems in some of the EU, well, all the EU countries and the G10 countries. And if you take the non-overlapping countries, you come up with 19 separate and distinct countries. And so I've done some work with some people in trying to identify some of the characteristics of the regulatory regimes in the different countries. So, in fact, if you look at the current issue of Business Week, there's a piece talking about banking reform is back on the back burner. And as you know, there has been some interest in perhaps in reforming the financial system even further here in the United States in recent years. And in fact, sometime soon, the Clinton administration will put forth its proposals for modernizing the financial system. It's probably not my choice of words, modernizing the financial system, but nonetheless, that's what the Clinton administration is talking about, is putting some proposals that would perhaps try to induce the Congress to make still further changes in the U.S. financial system. There is a report that has been prepared on behalf of the Clinton administration. In fact, I know the author of the report. He's a good friend of mine. I had been asked, actually, to help write the report. I declined for various reasons. And the report has been read by Secretary Rubin. He's gone through it, spent many hours talking about the report with the author of the report. Then, of course, you have an editor, a journalist, a very good journalist who's editing what's being written by this economist. And it turns out they had tried getting a report from a different economist and were somewhat unhappy with the product. And now there's been some delay in releasing the report, in part because what you do is you vent these types of studies. That is to say, you see what the likely reaction is going to be from all the affected parties. That would include the banks, insurance companies, securities firms, so on and so forth, and as well as to gauge the likely reaction to the report from members of Congress. And right now, the reaction from the Congress is not all that favorable to what I would call more sweeping regulatory change. Therefore, the Clinton administration is considering perhaps revising the report or pulling back from some of its initial proposals. That's not unusual. It's an interaction of politics and economics or finance, a combination of the three. So it's not yet clear what's going to happen in the report, what it's going to say and what the administration is going to do. An area of contention has to do with whether or not banks should be permitted to own stock in non-financial firms. That's a major issue. And indeed, it turns out that the Federal Reserve, Alan Greenfield, has recently testified before a subcommittee of the House Banking Committee opposing bank ownership of non-financial firms. And indeed, Chairman Leach, the chairman of the full House committee, testified before the subcommittee, which is not all that unusual. It's not all that common either. It turns out that he presented a lot of information about why it would be a bad idea. Basically, because he argues that there'd be not just potential conflicts of interest, but you'd have conglomerates mega firms that would tend to dominate a particular segment of U.S. society and potentially lead to oligopolistic, monopolistic type practices. Somehow, in some way, if non-bank ownership of non-financial firms would be bad, in other words, for U.S. consumers, if not taxpayers and others as well. But in any event, and it's interesting that the people who prepared all the tables of Company's report were people who work at the Federal Reserve System. So Chairman Leach is very close to the Federal Reserve, and it's not surprising that they share similar views about bank ownership of non-financial firms. Also, there's the issue of non-financial ownership of banks, which has been effectively restricted in this country. It's an issue of talking about these things. I did bring, and then of course there's an issue. John Wells sent me an email just before I came here. We hear a lot about privatization of banking in different countries. The former Soviet Union countries, I believe there were 15 or 16, as well as here's a piece that John sent me about Romanian Senate approved bank privatization bill. So we have state banks in this country. Some people say what we ought to do in other countries is get the state out of state banks, because in other countries they do have there are indeed many government-owned banks or state-owned banks in the countries, and those banks have performed somewhat poorly. You can look at one of the biggest banks in France. You can look at some of the banks in Italy and some other countries. An issue of who should own the bank. Should it be the state or the private sector? I brought a handout to sort of perhaps get us talking about these issues. I didn't bring all that many, but I figured that if necessary, two people could look at the same handout. And this is going to be very simple for some of you, and some of you clearly have studied many of these issues in the work that you do. I should admit to not being all that familiar with some of what's done by Austrian economists. I'm not intimately familiar with some of the writings of Austrian economists. I have looked at a couple papers as a result of the recent Lou and Jeff, they said to invite me to attend some of the sessions at their conference, in which people in different countries participated. So I did look at one or two papers. And there's an issue about fractional banking, a paper on fractional banking. And so I was looking through the paper, and apparently von Mises has advocated what is, to my way of thinking, is a narrow bank. I don't know if that's correct. Maybe some of you know. Leland probably knows a lot about some of these things, but in any event, I have not read some of the works by some of them associated, I guess, with the Austrian school, but maybe that's a perspective that you can enlighten me about. It turns out that they look at this first figure, and this is by way of trying to get you to think about some of the issues. Designing a financial system, I don't say who should design the system, clearly not me, but we do have financial systems, different types of financial systems in different countries. So this is by way of getting you to think about the issues. You have, obviously, and we teach this in economics courses, finance courses too, we have savers, people who save, and you go back to, most of us still teach, or some of us do at least, about Irving and Fisher's sort of approach to the motivation for saving, and it's really postponed consumption. So we have these two-period diagrams that we typically use to talk about how people can be happy by saving today or borrowing today, as well as saving, things like that. We have then a capital asset pricing model that we talk a lot about in advance about how people, if they do save, allocate their savings among different types of financial assets. These sorts of models are questioned by various people, the underlying assumptions in that, and as to whether or not they really do adequately explain the real world. And that's essentially what I'm trying to do, is expose you to some, what I call, as they used to say with respect to these growth theory models that were quite prominent, is one observed in the real world, so-called stylized facts, and then one developed a model to explain those facts. It was a matter of trying to make some observations, say, how do we explain what it is we do observe in the real world? And that's effectively what I'm in the process of doing now. That is collecting some information, hopefully facts, and then trying to see if we can explain why it is we observe what we do, not just in the U.S. but in other countries. So here, basically, we have savers and lenders, and we have borrowers and investors. And basically, the funds can flow from savers to borrowers in different ways, or a combination of ways. For example, you see down in the bottom, there's a box that says financial firms. We think of banks and insurance companies, pension funds, a wide range of financial service firms in the United States, and funds can flow through them, and then in turn, the funds flow on to borrowers, basically. And we sometimes say that these are the intermediaries. The banks can intermediate between savers and borrowers. And the question is they then provide credit, and they do some things that the savers themselves don't have to do, such as make decisions between individuals who we might say might be good borrowers versus bad borrowers. Then they monitor, supervise the individuals who turn out to get funds, say from banks, which in turn have gotten some funds from savers. And as we know, banks also play a role in the payment system by issuing liabilities that serve as payments medium in an economy. But a lot of this today, when you look, it has to do with information. And we talk a lot today about asymmetries of information, adverse selection problems, trying to discern between good and bad borrowers. We talk about moral hazards sort of problems. The fact that what happens is once you lend money to a firm or an individual, you have to sort of monitor an individual, be sure that the individual or firm uses the funds in the way in which you intended. That can be done by individuals, but frequently it's done by these other types of financial service firms on behalf of individuals. Then you can see I have in the upper box here that basically you can have money in capital markets, that you can have the marketplace in which firms go directly and raise funds, issuing stocks and bonds. And that's an alternative in some respects from going to banks and getting, say, loans directly from banks. So you have to ask yourself, when you look at this type of system, and in the middle I just put some sort of problems that one encounters in financial systems, most financial systems, and then perhaps ways in which these types of problems are overcome or resolved. And then you'll have to ask, are there failures in some place? We call them, at least I'm used to thinking in terms of market failures. Do they require government intervention? And are there costs of government intervention exceeded? Do they exceed the benefits, or vice versa? So that's how I sort of start looking at the system and think of returns and risk associated with this entire system. So you can ask yourself, what do the systems look like? And this could be a country would have this type of diagram, or you can think of the whole world as being embodied in this type of diagram. That is, you can go from savers to borrowers in different countries and through different types of institutions or firms or capital markets. Okay, let me sort of move on so I don't take too much time. Then I just gave you a schematic, which I don't want to say too much about, but you're all familiar with this diagram. It just shows you the way in which the U.S., at least by my way of thinking, has been regulated. The banking institutions have evolved over time in the U.S. from, say, 1781 to the present time. And progressively, what we've done is we've increased the regulation of the government involvement in the banking system. The government's gotten heavily involved in different ways over time, so that we've become effectively a country in which banks are perhaps more heavily regulated here than in many other parts of the world, and certainly more heavily regulated today than they were many years ago. And that's why some people are suggesting that we ought to deregulate our banks, more so than we did, say, in the early 1980s. I won't go through this, but you all familiar with how we got deposit insurance. And there's a lot of what I call interesting work being done in which people are going back and revisiting the 1800s, revisiting what's happening in other countries, and sort of telling different sorts of stories today than were told some years ago in many of the traditional banking texts. That is, that perhaps Glass-Steagall, which separated investment banking, commercial banking, really was based on an incorrect premise. That really It wasn't there wasn't really a conflict of interest between both commercial bank and investment banking being done within the same financial firm. That we can't attribute to the stock market crash and all the bank failures of the 1930s to a mixing of commercial banking and investment banking. That wasn't the case, and there's some good evidence to support that point of view by some economists, or financial economists, whatever we call ourselves, or they call themselves. And progressively, though, we really have, in a major way, I think, intervened in the marketplace. We even got the SEC, which requires a release or public disclosure of certain information. You have to say, would that have happened? Did firms have an incentive to release information on their own, to disclose information, to establish a reputation which had value to them over time, or not? Did we need the SEC required to? And then, of course, now you can sue, and firms do. And I've been involved in some of those cases in which there are class action suits brought against firms arguing that they didn't disclose material facts, and that usually those suits are brought after their losses sustained by investors, claiming they didn't know certain things weren't disclosed and that were material to their decision-making processes. In any event, this just shows over a period of time we've moved increasingly into regulating. I won't go through all this, but if you read, I think, contemporary documents or even past documents, a lot of people go through and debate, was wildlife banking good or bad? Were there runs on institutions that were destructive to the payments and in the credit system? How many runs? How severe were they? Were they in the people now say that a lot of the so-called systemic widespread run banks have been overstated. The problems weren't as bad as they say. Private note issue perhaps didn't have the sort of problems. National bank notes, when they came into existence, really didn't provide for a uniform currency. There were different exchange rates in different parts of the country, even for national bank notes, all those sorts of things. In any event, the U.S. Constitution sort of provides the rationale for the government, the congressional involvement in our banking system. It authorizes them to delegate authority, such as establishing a central bank, the Federal Reserve. It comes from the authority given to the Congress to get involved in banking. And that phrase there, it's not a period after thereof, but that phrase is sort of the rationale for government involvement in the U.S. And it has a long history, as we all know, presumably goes way back to what has happened in other countries, and it goes back to medieval days and beyond, in which it's useful to be able to create legal tender to fund armies and bureaucracies, all those sorts of things. But in any event, this is just you can look at a time series that has looked at the U.S. and talk a lot about the rationale or lack of rationale for government involvement in the banking system and financial markets in general. And incidentally, when you look, banks, for example, weren't permitted to branch, as we all know, throughout most of the United States. Even with the recent legislation, the Regal-Neal legislation, it turns out there are heavy constraints on the ability still to branch nationwide. There's a cap on the percentage of deposits that one can control in a single state, and there's a nationwide cap on the percentage of deposits or assets that a single bank can control in the U.S. So it's not as if we've gone to nationwide banking and branching. States have been permitted to opt out certain portions of legislation. But I tell you that some information I put together, and I was visiting the OCC in a document about the most useful part of the paper is not the words maybe that we use to describe the tables, but the tables themselves. Some of the information is nowhere else available, as far as I know, in any single place except this document. And why is that? Because I was able to visit some countries, European countries, and talk to the bank regulators and sent a questionnaire to them, and they provided information which they wouldn't otherwise provide had I just been an academic. So they were quite cooperative, and some of the information is quite useful. And you're free, if you wish, you have any interest, you can have a copy. Be happy to make one available to you. But the banks couldn't branch, so it made them smaller than they'd otherwise be. And I'm not going to go into that sort of history and debate, but you can think about why they couldn't branch, what are some of the issues. Banks couldn't own real estate, for example, even national banks until the late 1800s, 1900s. They were prohibited from buying stock in other firms. Consequently, it limited their size, and some people say that stimulated the growth in our capital markets. and why it is that banks, for example, didn't grow and become much larger in this country than they actually did. So maybe it's why we have these boxes, and I'll come back to this in a second. The financial firms are so much more banks in particular compared to the capital market, and I'll give you some indices of what I mean by that in a minute or so. So it even in insurance companies at the turn of the century until they can't own stock in firms any longer. So if you look at portfolio insurance companies, you might say, why do they hold a lot of bonds, not much common stock? Well, what I'm suggesting is don't look to market forces, don't look to competition necessarily in answering what we are trying to explain, what we observe. Frequently, you can turn to laws and regulations, and that's what I'm suggesting. It's not always market forces that explain what we observe in the real world, though they can overcome regulatory impediments, to competition and those sorts of things, the pursuit of profits. But frequently, laws and regulations explain what we observe. And the key is to sort of ask, are those appropriate laws and regulations? Somehow defining what one means by appropriate. And one way might be, market efficiency criterion. In any event, so it's very interesting if you go through and look at the development of financials. I mean, I think it's phenomenally interesting. Some of you have spent more time than I have, so I take there's nothing original, in laying out the laws and regulations and those sorts of things, but it's an attempt to try to tell you. A lot of people try to look at this history for the U.S. and explain it, and try, why do we observe all these laws and regulations? We have public choice people, we have political economy people, and a mix of others who try to do so and conclude. Are these laws and regulations on the books because they corrected market failures, or are they in the books because they impeded maybe efficiency on the part of certain types of banks vis-a-vis other financial firms, and perhaps fueled the growth of the capital market, which may have been a beneficial result of some government intervention. But it is interesting that our banks didn't grow as large as they have in some other countries. Very heavily restricted what they could do. Insurance companies too. So if you go to the next table, it's one just showing some comparisons in terms of world population, world GDP, world banking assets, so on and so forth. Lou has informed me that there are about 200 countries in the world, and I sort of agree with his figure. And if that's so, we've looked at 19 countries, EU and G10 countries, and you can see when you go down to total, you can't see it obvious, but if you go down, you find out that when you look at these countries, and the reason I wanted to look at them is that although these countries account for about 14% of the world's population, they account for about 77% of the world's GDP, 86% of world banking assets, and 96% of mutual fund assets, and 82% of the equity market capitalization across different countries. In other words, you can explain a lot of what's happening in banking and financial design of financial systems looking at these countries. Because then what's happening now is you have the World Bank and the IMF trooping all around the world, trying to some degree impose a particular financial system on a lot of emerging market countries. And the question is, are they suggesting, if not requiring, a certain type of financial system that makes no sense to almost anybody who thinks about financial systems? Is it one that would be determined by market force, or is it one that somehow furthers the empire building of the World Bank or the IMF? Or are they looking for work? Having now found themselves playing a diminishing role in providing credit because there's a lot more private credit flowing into some countries, and looking for other things to do. And I don't say that. I say that with some seriousness, which is to say that they are indeed talking increasingly about global banking standards. I was at a conference in New York the end of last week, and on the panel with me was IMF representative, GO representative, and somebody from Congressional Committee, and lo and behold, the IMF was saying, yes, we need, and the IMF has hired within the past, I think probably 4 years now, approximately 125 to 150 financial economists. Those people just looking at banking type problems. And the IMF reports that there are probably 2/3 of the 181 member countries IMF that have experienced banking problems, if not crises. So you try to look and say, well, when they go into these countries, and the World Bank does too, and they hire academic types to go into these countries, what sort of systems are they designing and telling them to design? Are they stressing capital markets? Are they stressing banking systems, deposit insurance, and or are they relying more on market forces? Now, you might say, and what type of system should they advocate, or are they advocating is an appropriate one? Well, when you look at these tables, what I'll sort of suggest to you is that, for example, what people now do is they categorize countries. We've all heard about the German universal banking system. We've heard about the Japanese financial system, which is under a great deal of stress today. A lot of non-performing loans at some of the big banks. And they have, the biggest bank in the world is Japanese now, probably 7 of the top 10 are Japanese. We now have our biggest bank pales in comparison to the biggest bank in the world. Measured by assets. We could do it other ways, and our banks fare much better in terms of, say, market capitalization. But when you look at the data here, you find that we have what are called, some people describe as bank-based systems, financial systems, and some people then talk about what's a market-based financial system or an equity-based financial system. And I won't go into the details. And let me give you an order of magnitude. You can't see it from this table. And the market-based or equity-based systems, for example, 2 countries would be the U.S. and the U.K. Now, why do we call the U.S. and U.K. Equity market or capital market-based systems? Well, if you take the equity capitalization, okay, as a percentage of GDP, it's 110% in the U.K., and in the U.S. it's 80%. That is, equity market capitalization divided by GDP. It's 80% in the U.S., 110 in the U.K. Now let's go to Japan and, Germany and France as 2 other examples. When you do the same calculation, you calculate equity market capitalization and GDP. In Germany, you can't see it from this table. So it's 24%. In France, it's 35%. So people say, gee, Japan, for its financial system, relies much more heavily on banks than in the United States. In the U.S., we rely much more heavily on capital markets than the banks or other financial services. So if you looked at that first diagram, connecting savers and borrowers, savers go mainly through what? Banks in Germany, and in the U.S., they go mainly through the capital markets to the borrowers. 2 different type systems for the boxes, if you were weighted differently, even though there are players in both at the top side and the bottom side, or the north and south of that figure. So it's just a weighting. And why is it weighted that way? Is it market forces? And then you have to ask yourself, which I do, would the IMF advocate the German type system in a lot of emerging markets? Is that a more desirable system? And so we have to ask ourselves, it seems to me, what do you mean by desirable? Why does that system exist? Is it a result of competitive or market forces, or is it a result of laws and regulations? And it has something to do with corporate governance, which is frequently a term that, it's associated with a lot of work of financial economists. Okay, I say that because I don't always know. Sometimes people have PhDs in economics and they do finance. Sometimes it's people have PhDs in finance and they do economics. So it's a blend of the 2. But that has to do with what's the way in which you induce firms to operate very efficiently. We have what's referred to as a fragmented ownership system in the United States. That is, there are very few individuals who own large percentages of shares in companies. Usually, a lot of the stocks owned by very many parties, and we call it a fragmented system, which means there's a separation sometimes between the owners and then the managers of the companies. And we say they tend to be professionals, and we say that creates agency problems, which is to say maybe the managers don't always act in the best interest of stockholders, operate the firm as efficiently as they should. Well, there's ways in which that's corrected. One way is a hostile takeover. So you have market forces at work, even in a capital market-based system that tries to induce firms to operate more efficiently. And we could go into Michael Milken junk bonds and all Drexel Burnham LaBera and those things. But that's a way in which market versus system can work. It's also a way in which you can spend some time behind bars. It turns out that when you go to the German system, on the other hand, it's mainly the banks. The banks can own shares of stock in companies, and they own shares of stock in companies, and indeed they vote on behalf of. They're also custodians of shares of stock, and they vote those shares.
So they not only lend to firms, as our banks do, but what they do that our banks can't do is they own shares. And they exert a lot of control, and some people that's beneficial. They induce the firms to operate fairly efficiently because of their ability to not only lend, to own shares and vote those shares in companies. So some would argue maybe that's a better system. They're relying more heavily on the capital markets to impose discipline on managers who run firms. Well, when you take the two systems, why is it we have this type, our type of system, the Germans, a different types of system, is one better than the other? If I had to ask you to choose, which system would you choose? Which is the better system? Or if you were to design a system for a newly emerging country, would you design one after the Germans or one after the U.S.? Well, in part, it's not market forces that have resulted in the two different systems. In large part, it's laws and regulations. Our banks are told they can't own stock in companies, up to 5%. Okay, but it has to be totally passive. You can't vote it, no controlling interest, and under some cases you can go even higher than that, but almost without exception that's not the case. So our banks don't really exert any control over firms with respect to their ownership of stocks. If there's any control, it's exerted through the loans that they make. So banks, therefore, go to the capital markets much more so because they can't go to the banks and let the banks grow. Don't forget the size because of, in large part, branching restrictions. They can't go to the bank and service the bank more fully, especially as a result of Glass-Steagall. So you say, is that now desirable? Should they let banks service firms more fully by offering securities activities, not to say get involved in insurance and real estate? Well, that's a debate, and I believe economists today would argue it's time to do away with Glass-Steagall. The Federal Reserve has been doing that since '87. It gave permission to some banks to set up subsidiaries within a holding company framework so that they could indeed engage to a greater degree in securities activities. And the Fed says, well, you can set up this subsidiary, but you can't generate more than 10% of your total revenue from that securities subsidiary. And now they've recently raised it to 25%. Why did they raise it to 25%? Because of their brilliance, economic studies showing it's more desirable in some ways? No. Largely because the Office of the Comptroller of the Currency has reinterpreted the laws under which national banks operated to permit the establishment of operating subsidiaries directly of national banks. And that opens the door for them to set up subsidiaries directly, bypassing the holding company framework. The Federal Reserve argues that the OCC, then once OCC did that, the Fed said, okay, 25%, for fear that probably some banks, national banks, would decide to just open an operating subsidiary of the OCC. The OCC has gotten two applications to set up operating subsidiaries, both from nation's bank. And now the Congress is very concerned. And it's probably about over turf. Do you want the Federal Reserve to regulate banks and have bigger staffs, or do you want the OCC to regulate some banking activities in OCC? And then what do you do about the state banks that can't set up necessarily operating subsidiaries? So the Congress is forced to do something just because of the preemptive strike taken by OCC. Mr. Ludwig, who has to recuse himself from a couple of these applications for operating subsidiaries because he had coffee at the White House, and you probably know what that means. It turns out, though, it is interesting times. Now, let's go to the next table. And in carrying on with what I just said, basically I tried to group the countries, me and my two co-authors tried to group countries in terms of the powers that they have, that they were permitted under their charters. So when you rank countries, I'm going to go through this quickly. The U.S. is the most restrictive country in the world with respect to regulating its banks, in every respect, when you include branching restrictions. Now, you might say, is that, again, you could say, is it good or bad? And we can debate what one means by good or bad and those sorts of things. But is this desirable? Should we do this? And we're out of step with the rest of the industrialized countries of the world. So you have to say, as an economist, if somebody asks you, well, you think we should change? Should we move more in their direction? Should we deregulate? What are the pros and cons? One thing that's interesting is that despite all our restrictions and the heavy government involvement and all the thousands of regulators, we've had problems. From 80 to 95, more than 5,000 federally insured depository institutions failed. And by that, I mean, they were taken over by the government, dismembered, liquidated, or sold to other financial firms, and it cost approximately $200 billion. 200 countries of the world, right? $200 billion to resolve. The biggest, probably, financial disaster to strike the U.S. Since the Great Depression. And indeed, the savings and loans, which account for the bulk of those costs, which were shared by taxpayers, which is why it's probably considered the most egregious disaster. The savings and loans fared much better in the Great Depression than they did in the 1980s, if you can believe it. The losses borne by uninsured deposits were smaller than the losses borne by the Federal insurer in the 1980s. Interesting fact. It also turns out, so with all the restriction, and we really didn't get a lot of a big bang per buck when you look at the crises in other countries. Furthermore, when you look at other countries, they had nothing. I'll make a blanket statement. It's up to you to disprove me with facts, okay? A blanket statement that when you look at all these other countries, the two-thirds IMF, you don't find that the problems with failed institutions, they're either associated with state-owned banks or they're associated with the classic problems, which are fraud or real estate problems, commercial real estate problems. It wasn't securities activities. It wasn't insurance activities. It wasn't the commercial real estate activities. And it wasn't the commercial non-bank ownership of banks, or that is non-commercial firm ownership of banks, or the bank's ownership of non-commercial. See, that didn't have anything to do with these sorts of problems. But the concern, nonetheless, on the part of our Congress is indeed that it would be concentration of power if we move too much like other countries. Conflicts of interest is usually used. What that means, if a firm has a securities subsidiary, what happens is you come to me as a customer. For example, I'm giving you securities advice. I say, oh, well, why do you want to underwrite? Why would you want to go out and raise capital, raise funds in the capital market? It's my bank. We'll make you a loan. So what you do is there's a conflict there. You could help the firm by underwriting a securities issuance, or what you could do is make a loan, and we say that's a potential conflict. Well, banks, the whole world is a series of conflicts. The ordinary transactions, most of what they do involves potential conflicts. And that's why the regulators, presumably, if they do anything, is to keep those conflicts in check. Concentration of power is always an issue. How do you determine whether there's excessive concentration of power? What's your market? Is it the domestic, international? Citibank operates in 98 countries of the world. It's more countries than any other bank in the world. The second largest bank is an England chartered bank, but it operates out of Hong Kong, and it operates in 80-some countries. So our banks are increasingly global. Exxon gets over 80% of its assets and its revenues come from outside the United States. Coca-Cola has had a press conference saying we are not a U.S. firm. We have a headquarters. Our headquarters is in the U.S. 80% of the revenues coming from outside the United States. Over half the revenues is Citicorp, half Chase, half J.P. Morgan. Okay, you go on down the list. Are these U.S. firms? What are they? How do we want to regulate them? Banks can do more in other countries than they can in this country if they're chartered here. So again, what do you want our banks to be? How would you change this table if you did? Also, some people say because of deposit insurance, you don't want deposit insurance subsidies or discount window subsidies or perhaps payment system subsidies, the clearing of checks, those things through the Federal Reserve System. Any subsidies associated with those activities to flow through to, for example, securities activities, real estate activities, or insurance activities if you grant broader powers to banks. On the other hand, an obvious question is why not just eliminate the subsidies and provide broader powers? Well, it's Larry Meyer, who's at this conference, who's an economist, was until he became a governor of the Federal Reserve, was at St. Louis, basically said, well, there's a subsidy there, and when he was asked why not eliminate it, he said, well, it's politically infeasible. Therefore, we need restrictions on powers. It is an issue. Then the next to last table, so I'll give you a chance to make your comments, is ownership form. You might say doesn't really matter. Well, the point is, why should the government, you have to ask yourself, tell banks, you have to use a holding company to engage in certain activities? You can't choose your own corporate organizational form. It seems almost the height of absurdity to sort of say, we not only tell you what you can do with respect to the products and services you can offer, where you can offer them, whether through locate your branches, but then tell you the corporate organizational form in which you offer your products and conduct your business. We do that here. And when you look, this information sort of suggests, indicates that most countries, when firms have a choice, they choose to operate directly in the bank, a lot of their activities, which is sometimes referred to as a universal bank, or they operate through subsidiaries of the banks, these various activities. The holding company is not apparently the preferred organizational form from countries for firms given the choice in different countries. Across the board here. This information, incidentally, it's not unlike a part of this exercise. You would have thought this information would be readily available. The Congress is debating issues, the regulatory authorities, without knowing what's happening in other countries. So occasionally people just allude, well, there are problems in Germany. Somebody was telling me the other day, a congressional staffer, I said, well, tell me what those problems are. Well, they're very complicated. But we still have to do something. And I said, well, wouldn't you like a few facts? So the fact of the matter is you would think the Federal Reserve or the OCC, some of the agencies, they just say, this is the situation in Germany. But everybody talks at cross purposes. So part of the exercise is, you people are smart. You see I'm not giving any text. You look at these tables. You conclude what you think is the way in which maybe the U.S. ought to go if you offer it. See, it's not just me. I'm looking at the same table as you. And I can tell my story. But what I think is useful occasionally, we all have the same facts. We say, this is the situation in these different countries. Now, I conclude, no, the U.S. should be restricted. And then I say, why? Because all these other countries are. I asked Larry Meyer. I said, Larry Meyer, he heard some of what I talked about, and I've known him for years and that. And so I said, ask him a question. I said, look, based upon some information presented earlier, by me, basically. When you look at these other countries, the U.S. is out of step. I mean, would you conclude that maybe these other countries are all wrong? That is, they have a bad financial system. We should try to suggest to all these 180 other countries, taking out the 19 here, that they should adopt a U.S. type system, and not adopt, say, the German system or one of these other systems. And he said, Jim, Jim Barth's done some good work, very informative work. Unfortunately, we have to look beyond just these mere datas and what's going on in other countries. We have to think fairly broadly about these, what I call Greenspan-esque or speak or whatever, how we describe it. Meaning, he's saying very good, quite very complicated. These are complex issues. We live in a world in which you have to balance political factors and economic factors. And basically, we have a very good system that has lasted and served us well for more than 200 years or something like that, and we can't make big changes. And and I would have liked to have made it just a blanket statement. The German system's terrible, which is what Congressman Leach is more prone to doing. But nonetheless, I didn't expect him to answer fairly directly because I don't know what the answer is, to be quite honest. I mean, I don't know, and yet. Is the U.S. system the best system? How do you define best? The German system? That's something that you people can think about and try to address. Well, I think the German system regulates, and the Japanese regulate their capital markets excessively. They tax things. You can't own shares and stocks without paying heavy tax or issue them. So I'm not yet a thorough expert on all the different laws and regulations or tax systems, but you find that the Germans don't have the system they have solely because of the workings of the market forces in a competitive environment. And a lot of times the government then benefits the banks by regulating the capital markets. Now, we seem to do the reverse. So maybe, we're going to move towards a better blend of the top and the bottom, the north and top south boxes, if you will, on chart 1. So ownership is even an issue. The U.S., and say, look at the U.S. Organizational chart. When you look at the U.S. in Table 4, it says corporate organizational form. Look at the U.S. See, you can't put the U.S. on the same table as the other countries because there are too many boxes. Okay? And notice there you say restricted, prohibited. Here you have to say limited and varies. Okay? To put this together required the attorneys. Okay? I have a former student of mine was at George Washington who happens to be head of one of the divisions at OCC, so she's a very good attorney. and the general counsel. So they put a group of attorneys out, and the attorneys got, we can't do it for the U.S. I said, look, should OCC issue a document saying we can tell about, what can be done in a holding company or a bank or a subsidiary bank for all these other countries? 18 of the 19, but we can't do it for the U.S. I said, OCC wants to admit publicly. We can't, it's too complicated. Does it suggest something's wrong if you can't tell what's being done where? And so the attorneys worked on it, and they said, you have a point. I guess it would be embarrassing. So, see, to omit the U.S., and so we can do it for every country but our own country. It's too so all the footnotes here, see, are meant to provide the qualifications. Now, I took a crack at it when they said we can't do it. Then I filled out the box, and I said, well, we won't say source OCC. And it turns out it's interesting when you look at what happened. We priced it based upon failures of banks, state and national banks from the 1860s all the way through the 1930s. That's how we decided how we're going to price it, and we set the price a bit low, thinking that never again, with all the good regulatory apparatus in place, the losses would be a bare minimum. See, once we had deposit insurance, when we established the federal and bank system, FISLIC, FDIC, we said, with all these great people and the government now supervised and regulated, we wouldn't have losses again that would amount to anything until the 1980s, obviously. So all the countries now are running fairly rapidly to do what? Adopt federal deposit insurance systems, regulatory systems, beefing up their staffs and those things. So what we have is a mad dash, I would say, with the encouragement of the IMF, the World Bank, and just about everybody else, to establish a system that works. Even though there are some countries in which they haven't had deposit, there have not been government deposits in which they haven't had problems. And so you have to ask yourselves, is the deposit insurance system in some sense a way in which to minimize banking-type problems, or is it a way to exacerbate or precipitate banking-type problems? And when you look here, you find that we have who supervises is even an issue. Should it be the central bank? Should they also be involved in regulating and supervising banks if you have deposit insurance, and therefore you argue that's a rationale to regulate and supervise banks if there were no other rationales? Well, it turns out in some countries, about 50% of these countries, the central bank is involved in regulation and supervision too, and examination, like in the U.S. In other countries, that's not the case. But we have the most regulators. Okay, we create more jobs for the regulators because of the dispersed nature of regulation in this country. It probably doesn't make a lot of sense. We don't need as many regulators. Now, some say it's good to have multiple regulators because they compete with one another. Sometimes it's the benefit of the marketplace. I think of the example of Wisconsin. The state regulatory authorities provided their institutes with the ability to offer adjustable rate mortgages. And it wasn't so at the federal government, largely because in the mid-1970s what happened, William Proxmire, then chairman of the Senate Banking Committee, got a notice that his mortgage payment was being increased. He got outraged. He says, why is it? He says, you have what's called an ARM, an adjustable rate mortgage. He said, what is that? He said, I thought there was nothing but fixed one. Why should homeowners have to pay more as, say, market interest rates go? That's outrageous. That destroys the ability of people to stay in their homes. If their payments can go up, it might be that they, it takes away from the food budget, other budgets, and they might default them. That's bad. We want to promote home ownership. So the Congress, he and his colleagues, passed a moratorium. No adjustable rate mortgages for any institutions nationwide. Then, of course, that was the mid-19th. So, lo and behold, interest rates went up. Fixed rate mortgages, savings loans went into the tank. Okay, who benefited? Homeowners who suffered. We just shifted the risk from the people who got the mortgages to the institutions. They found that, why did that happen? Do you think those institutions were being run by fools? They would not have offered adjustable rate mortgages or they were prohibited from doing so. And they got other benefits, presumably, and they didn't have to in a stable interest rate environment. Well, that tells you how we got fixed rate mortgages. It wasn't just the institution's desire to do so. And when you look here, look at who administered the insurance scheme, the funding, is it ex ante, ex post, and the dollar amount. Now, the IMF says the amount of insurance should be 3 times per capita income. That's the rule of thumb. And they want every country of the world, all 200 countries, if that's how you do it, to have 3 times. They want all to have federal deposit insurance. They want the central bank to be involved in regulating institutions, and they want it to be 3 times per capita income. and increase. Now, you have to say, why 3 times per capita income? How do you price? And they want all schemes to be ex ante. Ex post, ex ante, no ex post deposit insurance system, all government administered, and they want, of course, the IMF to be play one of the key agencies in international or global bank regulation, which makes sense, okay, if you're there to do those sorts of things. And I think it's ideal. I don't know that it's yet an issue that. My only point would be it merits public discussion and airing of debate among the Congress and others, saying, well, what about global regulations? But about the time we get to debate, they already will have been imposed, and we will already have these systems in place and all these other. It is as fast as IMF and World Bank. They've gotten their troops all over the globe imposing, and it's not bad. I haven't done it. I've been offered the opportunity to go to some of these countries and do their system, but you have a lot of academic types who do this. And it's amazing how many banking experts there are now in different institutions. Tell me, I just came back. Boy, it was fun setting up a deposit insurance system. I read a few papers, went over there, and told them what to do. And that's the mentality. I'm not saying it's bad. These aren't smart people, but you wonder if that's what we should be doing, if it's the right way here in other countries. And the last thing I'll close on is you can get into trouble talking about things. I made the following comment. Somebody who said, well, banks get a lot of insured deposits. Those insured deposits help house America, all those sorts of things. And I said, well, look, it turns out only about 50% of all the assets of all depository institutions in this country, and they have about $5 trillion in assets, are funded with federally insured deposits, meaning they're not absolutely essential. That it used to be much higher going back in time. So about 50% of federally, meaning they can fund half their assets with non-federally insured deposits. And some banks, big banks, only 20% of their assets are funding with federally insured deposits, suggesting that they really need those federally insured deposits. And only approximately 15% of all the assets of all financial firms and service firms in the United States are funded with federally insured deposits. And then the question is, have we reached the stage which maybe we should do away with federally insured deposits? A mutual fund is not unlike, is effectively, you can do banking transactions with your mutual fund, and if you give them access maybe to the FedWire, the federal clearing system, you have 100% capital, and it turns out you don't have federal deposit insurance. But when I made this comment in passing in reaction to another person who was speaking about the 15% being funded and a financial institution person, a mid-sized institution came to me. He says, I'm really troubled by your talk. I said, oh, my talk? He said, you were harping about the fact that we don't need federal. I said, I didn't say that. I said, well, you said that 15% of the assets. He says, now, by your saying that, you're going to frighten, or you're going to give the impression to people that institutions don't need federally insured deposits. He says, and I said, well, do you? He says, yes. I said, well, why? Now, of all the things you heard me say, I mentioned that, and he was very irritated with me. He said, it's people like you, typical academic, you don't know the real world and that. I went through that for a few minutes as we were fortunately having a drink, so I could better tolerate it. But it turns out that, and I said, notice everything I say, he forgot about the because he runs an institute. He says, we're mid-sized. He says, we get a subsidy. I said, oh, you do? And I said, I'm helping pay for it others. He says, well, that's not my point. Yeah. He says, my point is we get a subsidy. He says, our return is about 50 basis points on assets, let's say. And I said, well, what's the subsidy? He said, about 50 basis points. And he said, so if you take away insured deposits or you do away with the subsidy, we can't exist. And I started saying, so what? I mean, but then, I obviously didn't want to, get into, have him beat me up or something. But that's all I thought. And I said, well, you have this subsidy. And I thought he was going to say, that's a good point you made about 15%. A lot of people don't know that. Maybe it's not as if they get all their funding from insured deposits, and we're operating a big economy. It's dynamic, growing, and innovating, and we don't have all these insured deposits funding everything. Instead, he got to say, and guess what? Some people are saying this subsidy really doesn't exist. Is there a subsidy? Well, he comes blatantly out, and that's newsworthy. Say, I get a subsidy. I wouldn't exist without the subsidy. And that. But in any event, it is an issue. And the question is we have to ask is, should that particular institution be getting that subsidy? Is it appropriate or not? Do we think because of that they're attracting funds and funneling them to public goods, merit goods? Housing is a merit good. Is that what we want to say? Is there some failure that is being corrected with offering that type of insurance today? Well, I've gone on. You've been patient and let me sort of say my spiel listening to me. But I would encourage all of you. I think this is a very interesting area, and for me, to be quite honest, you can see there are no equations, no statistics, statistical analysis, which I used to like to doing a lot of. But unfortunately, this is an area in which I've come to appreciate the fact that not everything can be easily quantified in a model or easily, no offense to some of you, but easily use econometrics, which is at one time I always thought if it was anything I did, if it was viewed as scholarly, there had to be equations in econometrics. But I found in this area, trying to talk about corporate governance, and there are, as Clara well knows, a lot of people do some good work in this area, and Claire works in this area too, in corporate governance. But it turns out that part of it is I can't get my hands on some of these issues without some simple tables and using some words, the English language, to try to talk through these issues, which is a real challenge. So when you go back, and what's impressive to me, the other thing, so part of it is I can't just write down a model. I can't just say I'm going to estimate this equation and tell you which is, but yet I think these are profoundly interesting issues. And other people have addressed them. And it's so amazing when you go back, and I'll close on this note. When you go back and you read what people wrote, including obviously people in this room, Lehman obviously knows more about many of these things than I do and many others, and knows clearly the history and the writings of many others better than I too. When you go back, though, you can't but appreciate the fact there are so many people who have written and told some of the stories that I now try to tell long before me. That is, look at the writings in the 1930s and earlier writings. You'll be impressed that they identified issues and talked about many of these sorts of problems. And it's nice to look at other countries, but always appreciate the fact that others have written about these issues. But sometimes we overlook the fact if I didn't see a model, I didn't see some statistics, I may not have done some of that reading. So all of us, I think, occasionally have a professional responsibility to try to identify those who came before us and wrote about similar issues. So when I was looking at the savings and loan problems, I was impressed reading some of the literature of the 1930s and in the journals. The people wrote and identified the problems. They didn't use the exact language, but they really had very insightful analysis. And nothing was a surprise in the 1980s. That is, moral hazard, problems of banks, and what happened. That all had been written about. Now, some of the modern day writers ignore a lot of it, and you don't see a lot of citations or references to the earlier literature. That's sometimes a bit of a shame. But I would encourage you, those of you who are interested, to look broadly at what's going on in these other countries and to go back. I'm very interested. See, in the U.S., I can go back and look there, but I don't know what happened in England and Germany, why they got the systems they did, the regulation. It's profoundly interesting because what we're trying to do is look out there and observe things and say, how do we explain them? Can we tell a coherent story as to why we see the things that we do? Is it market forces, through competition that have propelled these financial systems in one direction, or is it laws and regulations that have shaped the financial system? And do we want to try to shift the system in some way? What's an ideal system? And it's almost going back to what I call that phrase, first principles. Trying to just say, well, I used to say saving goes to borrowers. Like it was so easy. But then that's a relatively profound statement. Well, how do you go from savers to borrowers? How do the funds get there? And does it matter? Do they go through financial firms or capital markets? And why do we have differences in different countries? And it started to be pretty darn interesting to me. And so I started to spend a lot of time reading some legal type documents, what other people have said, and it is really sort of interesting. And there are a lot of people, I think, or more people interested. And it attracts, incidentally, some of the people who work in this area are now a lot of attorneys. I think of Jonathan Macy and a guy named, Mark Rowe at Columbia University Law School. There's John Macy at Cornell's Law School. Some other people, and at Stanford University Law School, so a couple of people I know in the law faculty that I communicate with as much of interest in these, because it does involve laws and regulations, finance, and economics. Okay, Joe?
Well, I'm afraid we're out of town, but thank you very much.
No question.